Hey there, home buyers. This is Amir, Syed with your Mortgage Minute. As you know, this is a collage of videos that will give you a lot of education with the various things that are involved with the home buying process, or if you're a homeowner, it can also help you as well. So today's topic is going to be about fixed rate mortgages versus adjustable rate mortgages, otherwise known as ARMs. It's a lot of questions that I get during the first face-to-face session that I have with my home buyers is, would it make sense, Amir? Should we do a fixed rate? Should we do an adjustable? Typically how we disseminate between the two is based on three factors. One is the length of time you'll be staying in the home. Secondly, it's your type of income structure. If you're commissioned, self-employed, or a seasonal worker, there may be ebbs and flows in how much you can afford. And then third is essentially how comfortable you are with managing the risk should that adjustable rate mortgage change after a set period of time. So to not make this as boring as possible for you, the most common fixed rate options are a 10-year loan, a 15-year loan, a 20-year loan, 25-year loan, and 30-year loan. The most popular one is a 30-year fixed rate mortgage, right? Your rate stays fixed for 30 years. It'll never change the payment no matter what happens to the market conditions. It's the most popular product for first-time buyers because it's your first home. You're getting into a new financial situation, so it just brings a lot of consistency. Adjustables. The most common ones are 3-year, 5-year, 7-year, and 10-year adjustable. There is, believe it or not, 1-month adjustables, but really the most common ones are 5 to 7-year amongst those four options. So essentially your rate stays fixed for 5 years, and then it can adjust at certain measurements in the 6th, 7th, 8th years. There's usually caps, which means if you do a 5-year adjustable rate mortgage, if there's a 2% cap, that means the most you can adjust to is by 2%. So let's say you get a 3% 5-year adjustable rate mortgage. After 5 years, no matter what the market's at, it can go to 5%, right? 3 plus 2 equals 5. If you plan on staying in the home for sure 5 to 6 years, then a 7-year ARM would make sense. I will tell you this. A lot of my younger first-time home buyers, especially myself, when I bought my first place, I was out of that place in 6 years. Lifestyles change, you meet somebody, you have to get relocated for work, or you make more income. It's very common. Sometimes people will end up renting their condo, so at that point I'd say consider doing a 30-year. The difference between a 30-year and adjustable, or a fixed rate and adjustable, typically the rates are a lot more aggressive on a 5-year, 7-year, or 10-year adjustable rate mortgage. Your payments are cast over 10 years, but your rate is only fixed for 5 or 7 years, which means your interest rates can be a little bit lower, okay? If you're a seasonal worker, obviously, you want the lowest payment to be able to take you through some of those, like low income earning times, and then when you're back at work or you're making more money in commission, you can pay down towards the mortgage. So, long story short, it's important for you to understand the different options that are out there, but when you meet with your lender, when you meet with me face to face, it's really critical that you talk those things through and you get the right product. So I hope this wasn't too long. I know it wasn't a mortgage minute. It was maybe a mortgage 3 or 4 minute, but it's just important stuff, okay? As always, reach out, ask questions, take your time. Hopefully this information will allow you to make the best decisions for you and your family so you can be as successful as possible, okay? Talk to you soon. Bye.